Hey everybody, good to be here today. My name is Brent Moores, and today we're talking about long options. Specifically, we're going to talk about leaps today. Do you know what a leap is? Well, if you don't know, I'm going to tell you what leaps are, and um, and how do they relate to long options? Well, they're a type of long option. So we're going to get into that in just a few minutes. But before we do that, let me just mention a few things. I'm joined alongside in the chat by Connie Hill, who's helping me out today. Appreciate Connie. And you can follow her on Twitter. You can follow me on Twitter as well at X, not Twitter, X. I need to get updated with that. At Brentmore CS, at Connie Hill CS. And of course, options do carry a high level of risk and are not suitable for all investors. The information today we're going to go through is for general informational purposes only. It should not be considered an individual recommendation or endorsement of any security, strategy, or chart type. Paper money application will be using Thinkorswim desktop software today. That is for educational purposes only. And for the sake of simplicity, I may not factor in commissions when I'm doing trades, but just realize they are present and real. All investing involves risk, including risk of loss. Stop orders do not guarantee an execution at or near the stop price. And past performance of any security or strategy does not guarantee future results or success. And paper money virtual trading application will not exercise a short option early. So just be aware of that. We're not going to be dealing with short options, I don't think, at all today in this class, but you never know, I guess. Let me head on over to the Thinkorswim platform. I'm glad you're here. I see some familiar names, and I appreciate each of you. And those of you I don't know, welcome. Glad to meet you. Glad to get to know you. And let's go. This is the S&P 500. You can see, hey, we've had a pretty good rebound. And you know, sometimes when we talk about that rebound, when we talk about the S&P 500, we can talk about how concentrated it is in just maybe the Mag 7 stocks or something. But let me show you this. I posted this on X earlier today. Slightly different graph, but this is stocks in the S&P 500 that are above their 50-day moving average. This is expressed in a percentage term. Well, it's about 50% right now, which you can see is way up from where we were just, what, a week ago? A week ago, it was like 15%. So you can see kind of a bullish, broad-based move in the markets. But that's not the whole point of what I'm going to be doing today. I just want to, I think it's important to know the context of what the markets are doing when we're trading, whether we want to take a bearish or bullish posture. What I'm going to be focusing on today is I'm going to focus a little bit more on a bullish posture here on this. So I'm going to be looking more at long call leaps as opposed to long put leaps. But just realize you can do long call leaps if you're more bullish. You can do long put leaps if you're more bearish. All right, so what I want to do is I want to define leaps for you so you know what they are, so you know what we're talking about. I want to go through kind of a sample plan. Over the past couple weeks, I have gone through, in this class, I have gone through sample investing plans. One for swing trading options, one for trend trading options. If you're interested, let me just put a link to the playlist for this class in the chat. Otherwise, you can just get that playlist off the Trader Talk Schwab channel. And you can review those if you want. Okay, so this is going to be kind of maybe the third in the series, probably the last one in this kind of sample investing plan series I'm planning on doing. But it's along the same vein here of those others. But this is specific for leaps trades. Swing trades, shorter term. Trend trades, more intermediate term. Here we're talking about long-term trading, LEAPS. LEAPS stands for, let's see if I can get this right, long-term equity anticipation securities. I think I got that right. You guys can correct me if I'm wrong on that. Basically, what LEAPS are they're options. They're just long options but with long expiration dates that are out a year or more. That's it. That they're a year or more. So if I go to a stock, let's just pull up a stock. We'll pull up AMD. Here's AMD. You can see your expiration dates right here. So maybe if we're doing swing trades, maybe we're looking out more in this time frame. Trend trades, maybe we're looking more out in this time frame here, 59 days, 86 days till expiration. But look, if we go out a ways, we can go out. That's a year out, January of 2026. Can you believe it's 2025 already? 2026 is just a year away. This is 2 years away, okay? 2 years from now. Leaps can go out like 3 years from where we're at. So there's some consequences if we do go out that far, some practical consequences. But just realize when we're talking about leaps, the rules still apply. When you have a contract with 100 multiplier on it, one contract controls 100 shares of stock. Well, that's true for the leaps too. Okay. There's intrinsic value, there's extrinsic value, there's bid, ask, stuff like that. A lot of that's going to be similar. But practically, when you go out farther, let's just compare. Let's go out a year. I'll just go a year here in this case, and we'll go out, I don't know, a month. So I don't need that many contracts. So let me just do this. When I go out a year and a month, and say we'll look at the 125 strike. One thing is they're going to be more expensive. Out a month, it's a $625 price tag on that one. Out a year, it's $2,300. Okay, so more expensive. That's one thing. Here's another thing. There's going to be more time value on this. The extrinsic value is the same. The extrinsic value is just the difference between the stock price and the strike price. So what's the difference in the $625 versus this $2,300? That's all time value. That will all decay. Now, sometimes that gets a little confusing because when I talk about more time value, you're thinking, ooh, that theta is more dangerous. Well, the rate of decay is actually higher, typically, when you get closer to expiration. This just has a lot longer here. But over time, that would certainly bleed out a lot of time decay on that option going out farther. So that's another thing that's an important consideration. Here's another one. Your deltas on your leaps are going to be closer to 50 in general. Now, you don't see that much if we're near the money, but let me get a few more strikes here. So let me go to 30. We'll go to 30 strikes here. Let's go to, say, $110 strike. And I'll just look at the calls. Same thing would be true with the puts, though, by the way. $110 strike is an 82 delta. Let's see if we have 110, we should have $110 strike here. What's our delta? 72, okay? Deltas are closer to 50 the farther out you are till expiration. Let me just say that another way. And this is true even as we get very close to expiration. As you get close to expiration, your deltas, okay, your deltas tend to either go up to 1, okay, if they're in the money, or closer to 1 as they're in the money, or they get closer to 0 if they're out of the money. Because think about it, at expiration, where's your delta? Well, if it's in the money, your delta is 1 at expiration. If it's out of the money, your delta is 0 at expiration. So you see that on leaps, that is a difference there. Longer expirations, what's the difference? Well, another difference is you have more time for your forecast. You're forecasting out further. And so practically, one difference is maybe how you analyze the company. Very often with shorter term expirations, and I'm going to make a generalization here. This isn't true for everybody. But in general, a lot of traders looking for shorter term trades will focus more on technical analysis. When you go out long term, the fundamental analysis aspects of a trade often take more priority or more of a factor in there. And we'll consider that a little bit today as we're doing this. So we may start to get some fundamental analysis in the equation here, which typically we don't do in this class that much for those shorter term options. And another thing, and this is true, shorter term trades, you're probably, if you're using stops, and remember stops aren't guaranteed, your stops are probably going to be tighter on shorter term trades. Longer term trades, typically looser stops. So having said that, let's kind of write out some rules here and just realize this is just a sample plan. This is not, there's a lot of different ways to do that. And I'm going to hope to illustrate that here going forward. There's a lot of different rules you could potentially do here. This is just simply a sample. It's not a recommendation here on what you could do, but just to kind of keep the same format that I've done over the past couple weeks with those other classes that I shared with you, by the way, in that playlist you can check out. We're going to do this. So here's what I'm going to say. And some of these are going to overlap with what we've done in the past. In fact, last week, the last 2 weeks, I've said all along, we're looking for liquid stocks with potentially liquid options. Okay, so that's just a repeat. Liquidity matters, and liquidity on LEAPS options matter too. Okay, so we're gonna start, and often that'll be looking at like the S&P 100, which I've done in the past. You don't have to do that, but have a list of more liquid type stocks there. In terms of buy rules, some of them are going to be the same. I'm going to say, I want a stock that's trending up, okay? Underlying stock that's trending up. Do you have to do that? No. I mean, look, I'm not sure, and just this is like, doesn't mean you need to follow what he does, but think of like Warren Buffett or something like that. I don't know that he doesn't really look for stocks trending up when he gets in. He's looking more at intrinsic value type stuff. So longer term traders don't always do this. But for our purposes in this class, I'm going to say we want a stock that's trending up, okay? So we're going to do that. So question from Journey 777. Before we get started, why would we do this? This would be, it's a good question, and it's something maybe I need to express more explicitly. This is a long-term option trade, okay? Instead of trying to trade in and out, this is more of an investment, if you will, okay? A LEAPS. So this is a good question. Now, this is probably a little bit closer to investing in a stock than it is, than say a short-term options trade would be. Now they're different, right? Stocks trades and these LEAPS trades are different. For one, LEAPS don't pay dividends. Right? So if you're in a stock and you want to take advantage of the dividend, then don't do a LEAPS, right? You buy the stock. Number two, there is an expiration date. The expiration date is put out further, maybe a year, maybe 2 years, maybe 3 years, but there is an expiration date. There's no expiration date on stock. So that's another thing. And here's another thing. This is going to be typically a more leveraged type investment. In other words, if the stock goes up, say 10%, how much are you going to make on the stock? Well, if you bought the stock, you'd make about 10%. If the underlying stock goes up 10% on this, you can potentially see very different magnified returns on this versus the stock. And the same thing if the stock goes down. If stock goes down 10%, you're gonna lose 10% on that stock. Stock goes down 10%, you may lose more than 10% on that. So just be aware of that. This would maybe a more aggressive, longer term approach alternative to stock, just understanding that it is not the stock. Okay? So I'm hoping that answers your question there, Journey 777. It's a great question. So trending up, that's one reason we do that. Now, I've showed you in the past sessions, you can use a moving average crossover to help. I may look at that today. You don't have to. You can just look for higher highs or higher lows. Higher highs, higher lows. Or you could look at I have like a 10, 30 MA cross. We'll look at that in just a little bit. Those are ways you can, not just the cross, but the 10 is above the 30 is how you'd say that. We'll just say 10, 30 moving average. Those are approaches to trying to help identify that trend. You don't need to look for a bounce, but you could look for a bounce here on that. That's fine. I'm not going to add that on there, but if you want to add in a bounce, you can look for a stock doing that, but you don't need to. It's a longer term trade. It's going to go up and down and go and whatnot. Now, here's where it really is going to be different. Okay. What I'm going to say is I'm going to look for some fundamentals here. Okay. Fundamentally sound. Okay. Now, there's a lot of different ways to do this, so I'm going to be real simple today. But if you are interested, and let's say you want to take more of a growth investing to looking at fundamentals. I did a class on the 9th of January in the Getting Started with Stock Investing class. I'm going to put a link to that class in for those of you live, but it's in the Getting Started with Stock Investing, January 9th of this year. If you want to learn more about doing fundamentals from a growth perspective on stocks. Similarly, a year ago, a little over a year ago, in the same class, Getting Started with Stock Investing, I did a class on value investing fundamentals. Okay, we're going to do kind of a simple plan today, and I'm going to put the link for that class in this class. That class actually occurred on October 13th of 2023. That was more value investing, if you're interested in doing that. But for our purposes today, this is what I'm going to say. I'm going to say I want to see growing earnings. I'm going to say a PE between 15 and 30, and I'm going to say favorable analyst's view. Okay. Now, I'm going to put a little asterisk by this, maybe. There's my asterisk. When I say favorable analyst view. So, here's the asterisk. The analysts are third parties. Third parties. They're not endorsed by Schwab. Okay, it's not a Schwab recommendation. All right, so just be aware of that when we start bringing up analysts. But what I would be lying if I said some traders don't use analysts, and I want to just make that apparent to you. Maybe you hate it. Maybe you hate the idea, and you say, "Look, they're wrong sometimes." Yes, they are wrong. That's objectively true. They are wrong sometimes. They absolutely are. Maybe it's to the extent that you say it's not worth even looking at them at all. That's fine. I respect that view. But a lot of traders do find it valuable to, in addition to your own analysis, to having just kind of a second pair of eyes on that trade. So that's why I'm going to do that. And if you don't want to use that, that's fine too. That's no problem. Okay. So that's my buy rules here on this Leaps trade. I'm adding in fundamentals into that, in addition to the basic trend. Okay. Basic trend. We're looking at that. Okay. Option specs. When's our expiration date? Well, by definition, expiration date, by definition, it's going to be 1 year plus, 1 year or more. Okay. Now, if you have a long-term bullish view that goes out on a stock and you want to be with it longer term, go 2 years if you can, or 3 years if it's available for you. You can do that. It's going to be more expensive though to do that, right? The longer you pay your expiration date, the more you're going to have to pay for that guy. Okay. All right. Strike. Now, in general, here's what I'm going to say on the strikes. I'm going to say strikes. I'm going to look in this for our purposes today. I'm going to say 60 to 80 delta. in terms of the strike. Find the delta that's between 60 and 80. If you want it to be more expensive, probably a little less leveraged, then you could go to a higher delta. Maybe a little bit more of a conservative way of looking at that, but it's going to be more expensive. If you want to be a little bit more aggressive, then maybe you go to a lower delta. You can go at the money. At the money is probably going to have a delta roughly around 50 or so. Okay, but those are the rules that I'm putting on this plan here. Feel free to adjust. And I'm also going to say a bid-ask spread of less than, let me see if I can find that on my keyboard, less than 10%, okay? Under a 10% bid-ask spread. So that's the same as the others, all right? So there's that. We've got two more categories here. We've got our risk management and section and our exit rules section. So risk management, I'm going to say a 2% risk. 2% risk on this. So I'm doing a little bit more on this. This is more of an investment than some of those shorter term trades where we were talking about a 1% risk on this. So that is going to assume, and it's a big assumption, we get stopped out at stop loss price. Okay. As I've said many times, that's not guaranteed to happen. Okay. And where are we going to put that stop loss? I'm going to tell you in just a sec here. Under our exit rules, we'll do that. Let's see, question from Agariba. We probably never get 100% on the trade. What's your target? Depends on the stock. Here's what I'm going to say. I'm not putting in a target price. In other words, very often on our trades, for swing trades especially, we may buy a stock and we may put a stop down, not stop, but we buy an option. Okay, we buy an option and we put a stop in case it goes against us, and we may put a target price if we hit that target price and just automatically get up. This is a long-term trade. As long as we're bullish on this and fundamentally things don't change on us, I'm not going to use that target. I'm willing to let go up and up and up. And if it makes 100%, great. 200%, great. 50%, great. I'm not going to cap it out with the target price on here. Okay. So yeah, I'd love to get 100% on that. You know, most likely that typically doesn't happen, but it certainly could. But I'm not going to cap that out with the stop price on that. So good questions. Thank you, everybody. So let's go to exit rules here on this. Okay. So I'm going to put my stop below significant support. Now, you'll remember, if you saw those last classes I did, we were putting a stop like 1% below the most recent bounce. No, this is a longer term, we're anticipating a longer term trade here. So when I say significant support, I mean not necessarily the latest little low that we had on here. Okay, so that's one way to do it there. I'm also going to say another way to do it is you can say put a stop at 70% of entry price on option. So that's price of option. Now you may go, Brent, a lot of times you've talked about doing like a 50% stop or something on those. Or this is a more expensive option. This one isn't going to be as volatile. Why is it not going to be as volatile? Because it's out further in time. And remember, those deltas aren't going to be quite as high typically. Okay, so they don't move quite as fast. So I'm going to put stop 70% of entry price. So if I have I have a $7 option, okay, $7 option. How would I do that? Well, I'd go 0.7 times 7, which would be, I'll do the math. I know the math on that one actually. That'd be 490. Okay, so that's where I'd put my stop on that. Okay, and that's on the option. Let's let's keep moving forward, and then let's go to some example trades here. I'm going to say exit on trend change. If the stock was trending up and it starts trending down, we're going to get out of that. Okay. I'm going to exit roll. I don't know exactly, exit roll, we'll say 20 days until expiration. Okay, before expiration. We're probably not going to let that go all the way to expiration. I'm going to also say I'm going to exit roll, and this is more of a choice, at 85 delta. Like with our trend trading, that's if we were to start with a 60 delta. Obviously, if we start with an 80 delta, I'm not going to roll this if I hit an 85 delta. In other words, if I start it closer to being at the money and it gets up to 85 delta, you may want to take some profits along the way. And then the final thing is we're going to move stop up along the way. That can either be below a new significant support level, okay? Below a support level, or we can periodically reassess and put that stop at say the 70% as we did up here and redo that. Now, Rick, did I write trading down? Exit trend change, yes. So how long does it need to be down is the question from Rick. I appreciate that. So yeah, we're not, just because it's down for, has a bad week doesn't mean we're getting out of this. What I'm saying is if we start trending down, what's the trend down? Okay, stock's been going up, we've been doing good. We start to get lower highs and lower lows. Lower highs and lower lows on using daily charts. In other words, each day is one candle. So realistically, that's not going to happen probably in a week's worth of time. Okay. Now, what if it does this in 1 week? Well, we'll probably hit our stop loss. Okay. But if the thing kind of gradually rolls out and we start getting a series of lower highs and lower lows, then we're going to do this. Ms. Street Fortune said, would a trailing stop work? You can use a trailing stop. However, here's my caution I always give with trailing stops. Nothing wrong with them. Okay, just like other stops, they're not guaranteed to get you out, exactly at the price or anything. But trailing stops, people tend to underestimate how tight they put trailing stops, and they end up putting it too tight. So if you're using a trailing stop, you may consider putting it a little bit lower than 30% below the entry price there. But you could use a trailing stop, yes. So good question. Good question. That's probably more true, that my caution on trailing stops is probably more true with regards to shorter term option trades. And the reason for that is they tend to move more in terms of percentages. Look, if I do, let's compare two options, just kind of hypothetical options. Let's say I do one that's a $2 shorter term option and one that's an $8 leap or something like that. It can very easily jump from $2 to $1 in 1 day, okay? Now, certainly this could drop from $8 to $4, but there's just so much time value in it, it does tend to be less volatile, okay? The price changes tend to be less on that. So my caution on trailing stop is probably more applies to this shorter term option than the longer term options. Okay. Now, question from Frankie. Yes. Frankie said, can you zoom out on this? And the answer is yes. Let me zoom out on this. Okay. Let me do that. 1 sec. Let me get out of my little drawing tool. And I think this is the last thing I had on there. So let me do this if I can. There you go. So it's kind of small, but if you want to do a screenshot, then you can do that. Okay. Let me just double check questions and then let's look at some examples. Okay. Can you use protective options in this type of trade? Yes, you can. Okay, so could you do, in addition to this, say an out of the money long put? Yeah, you could. Absolutely. Good question, Alan. Very good question. I like that. No doubt. Okay, so there's a screenshot for you if you want. Now let's go to the Thinkorswim, and I'm going to use these rules. Remember this. I mean, at the risk of beating a dead horse. It's a terrible expression, isn't it? I hate that expression. But there is, I'm going to use growing earnings, PE 15 to 30, and favorable analyst view for my fundamentals. But I'm going to start with trending up. So here's what I'm going to do. I'm going to go over here. Let's start with the whole trending up thing. I'm going to go to the S&P 100. And actually, before I do that, I'm going to add in, actually added in, I had a class, but you can customize this watch list over here, okay? So I have S&P 100. You can click on the little gear right over there, click on customize, and I added in a price to earnings ratio, okay? That's just a standard, there's no script needed for that. That's just one of those standard things in there. So let me click on OK. And then, make this a little bit bigger here. Then what you can do is you can sort by that PE ratio. And there's a couple of NA, which means usually that just means they have negative earnings or something like that. And go down. And so in my plan, I want stocks that don't have, I want my PE, what I say, below 30, I think. Below 30, okay. So here we'll go to 30. I'll start with Procter & Gamble. And I go there. So now I'm going to do here, I'm just going to scroll down this list, okay? And it's linked, right? I have orange 7, orange 7. So when I click on my little down arrow key on my keyboard, I can see it. Now, that has a PE that looks good. But what's the trend on this? The trend is poor. So I'm not going to do that one. Okay, Colgate-Palmolive, what's the trend on this? PE looks fine. The trend looks terrible, to be honest. Okay, Coke, well, it looks like maybe it's doing a little better, but I certainly wouldn't call it an upward trend by any means. Starbucks is looking a little bit better here. Okay, so I'm just going to jot this down, SBUX, and we'll look at some more too. I'm going to keep on going down the list here. Bookings, yeah, it was trending up, but now there's what I was talking about earlier when I was saying the trend change. High, we got low, lower highs, right? That's a trend change, okay? But for our purposes, it doesn't matter because we're not getting it in the first place. Here's Visa. Visa, nice little trend up. Let me just write down a little V there. Let's go on to Medtronic. That one's jumped up pretty significantly. I mean, we could look at that. That's MDT, and I'll just do a few more. Okay, Home Depot, not much of a trend. It's a few days up. Okay, Meta, I'm going to call that generally a good trend here. Okay, all right. Now, good question in the chat. Okay, there's my trend, by the way, on this. Question is, why did I choose 9 months? Okay. Here's the thing. It's kind of a balancing act. I want to be able to see enough detail on here that I can see the individual candles. And so if I go out too far, let's say I go out more than a year, then I have a hard time seeing all the little candles, assuming I have daily data. What if I zoom in more and look, I can go to 3-month chart, but then I start to lose some of the perspective on this trend and past support levels and stuff like this. Okay? So that's why. Now, could I just as easily use a 1-year chart? Yes, I could use a 1-year chart. Could I use a 6-month chart? Yes. I just kind of split the difference there and did 9 months. My concern is if I go much less than 6 months, I'm zoomed in, I lose the history that I want to see. If I go more than 1 year, then I want to focus on this more near-term stuff anyway, the last few months anyway. That's why. Hoping that makes sense on that. That's a good question. That's a question that comes up occasionally. And so let's do this. So Meta, I'm going to put that on our list as well. So we said there were kind of 4 things. Well, time flies in this class, doesn't it? Okay, 4 things I wanted to look at. I said, I want to look at the trend. I want to look at the PE ratio. We've looked at those. I'm going to go to the Analyze tab. Here's Meta, but let's start with our first one on our list, okay? So let's go to SBUX and just kind of look and say, what's my analyst favorability? Well, ideally, if you're looking at analysts, you'd probably like to see more green over here. This is kind of middle of the road there. I'm not going to talk about individual analyst reports here today, just my previous comment on those were that, remember, they are third party, not recommendations there on this. What's my earnings? Well, my earnings over the past years, I'm on the Analyze tab, fundamentals, earnings, it gives you a nice little trend. What's my trend doing on earnings? Well, it's not really trending up. My earnings aren't going up. Okay? My earnings are not going up. So let's see if we can get something a little better there. Next one on the list was Visa. Okay, here's Visa. Analysts. Oh, I got more green there on the analysts. So not a recommendation from them, but it is, maybe some traders may find that to be helpful. Earnings. Let's see what we got. This little graphic for 5-year trend seems to be good. Here we go. Over the last 5 years, earnings has been pretty good. And by the way, I think it's reasonable to consider that 2020, we had COVID and stuff. So sometimes you get some blips in this time frame here on this. But really over the last 3 years, we've had a nice increase in earnings. So that actually looks reasonable, okay, from that perspective. Now, so I want to look at this here in just one, but I just want to kind of quickly go through the others, MDT that we wrote down. Here's MDT. Again, analysts look pretty green there on that one. Earnings trend. No, earnings trend is just not going anywhere on that one there, right? Okay. And let's do one more, Meta. And we could have gone down Meta, and we could have gone down the list and done more. You saw the process though. I was using the PE ratio. I was looking at the trend, looking for my green on my analyst for this plan, and I'm looking for the earnings trend, and had a blip in 2022. It's back up there, but that's the general trend has been pretty positive on that. So let's do this. Let me go back to the one that seemed to be maybe the best looking one, and from that perspective in terms of earnings, PE ratio was reasonable. 28 isn't astronomical. It's not, a true value investor may not consider that, but this is not really a value investing approach here. Now, what I'm going to do for our we're going out to a LEAPS. Okay, remember, we're looking for a year. Now, where's my, here we go. Okay, maybe I'll zoom out just a little bit so you can see a little bit better. Oh, come on, going the wrong way. Okay, we did all this stuff. Okay, we did all this stuff. Expiration date 1 year, strike 60 to 80 delta, bid-ask spread less than 10%. Okay, 1 year. Well, this is 360 days, but we could do that if we wanted to. 513 days. Well, that's a little over a year here. And I can go to, we said 68, I'll go 70 delta. 305 strike. I'm out 500 days. This is a longer term approach. Remember, now Visa pays a dividend. We're not going to be getting any of that dividend by doing this LEAPS. Okay. So bid-ask spread, it's less than 10% certainly on that. So what I'm going to do is I'm just going to click on that for a sec. Here's our option. Let me close this down here. Now, we said we could set our stop at 70% of this price, or we could also do it below a significant support. Well, where's my significant support? Look, if we were doing real short term, we could say, oh, look, we just broke through this level. Maybe this is the old resistance that becomes new support. That's too close. I'm going to go down here and say, this is my significant support down here. That's certainly one way to do it, around 305, and go just maybe a little bit below that. The other way is I could do that 70% rule. Okay, I don't really have I don't have a huge preference on this one. What's 70% of 42, 20, 65? 4265 times 0.7 is equal to 2985. Okay. So I'll just say 2980. Okay. That's where, so I'm going to put in a stop on this. Oh, I could have just, let me just get the right contract. We did the 320 contract here. Actually, that's not right. I did that wrong. We were going to do the 70 delta. I clicked on the wrong one. Okay. So what I'm going to do here is I'm going to right click on this, buy custom with stop. Stop, good till canceled. I don't want that stop expiring at the end of the day. I'm going to go here. Let me redo my math on that because I think I did my math wrong. 5165 times 0.7 is 3615. 36.15 is my stop on that. All right. Good till canceled. One contract. Right. Now, if I wanted to, let me just do this. I'm going to confirm and send this. Make sure you read everything here. And I'm going to add this. We'll put this in our long options. Okay, long single options. We're going to send that. That's a bullish trade, right? Now, you may be going, you mentioned leverage earlier on this. One thing you can do, and I'm just about out of time, is you can go here, go to your Theo price. You can look at the contract. This is the contract we were doing right there. And we could say, what if the stock goes down, 10%? So I'm going to say the stock goes down $32. Okay, stock price adjusts minus 30. Well, actually, I don't even have to do that. I can do it in terms of a percentage. I'm going to say the stock goes down 10%, minus 10. Okay. Now I can see how is that going to affect my option? In the stock, we'd be losing about 10%. Look on the option, what's happened. Our ask price, well, we'll go off our mark. We've lost like 40% on the leaps, as opposed to 10% if we bought the stock. Now, that's the bad scenario if it goes down. If the stock goes up, we'd see a similarly nice result, a good result on that. If the stock goes up 10%, on the option, we'd be making about 20% or so. Not 20%, like 40% or so. So, and that's all theoretical. So just realize this is a more leveraged approach. It is not intended for the entirety of your portfolio. What I don't want you to do is just go out and say, I like the idea of making more money if the stock goes up, and this is the way to do that. Because the markets don't always go up, and this can work against you if this goes up. So this would only be for those particular trades where you are taking a more aggressive approach on it. Okay, everybody? So appreciate you. Thanks for joining me today. Thank you, Connie, for helping me on the chat. Make sure you subscribe. Trader Talks YouTube channel. And we will see you next week. Coming up next, we have Getting Started with Technical Analysis. Make sure you check that out. Everybody have a wonderful rest of your day. Bye-bye, everybody.